Now, if you had to pick a theme song for the financial markets in 2018, this one would work nicely. Let's face it, many investors probably feel like they spent most of 2018 riding the storm out, or hoping to, as the stock market experienced record levels of volatility. On today's show, we'll share my market forecast for 2019, along with the market forecasts of 10 other financial experts. The question becomes, will calmer skies prevail, or will the storm continue, or perhaps get even worse? Yes, it's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. I'm David Scranton. Long-term market forecasts are no easier to make than long-term weather forecasts. A meteorologist can tell you what the weather is going to be like for the coming week with a pretty high degree of accuracy. But trying to forecast snowfall totals for an entire winter, or perhaps average temperatures for an entire summer, let's face it, that's much trickier. And it's the same for economists and financial advisors when it comes to making year-long predictions for the financial markets. In fact, that's always been quite a challenging job, but it's even more challenging today for several reasons. One is that normal market rhythms and patterns are still being influenced by the leftovers of years of quantitative easing. Another is the constant jawboning between a couple of individuals, for example, President Trump and Jerome Powell, both which help fuel the market's unpredictability even further. But long-term forecasts are important, and today I'm going to share mine for 2019 while also getting expert insights and predictions from 10 other top advisors. The goal, as always, is to provide you with important details and information that you simply might not hear anywhere else. Information geared toward helping you make the best decisions possible to meet your financial goals in 2019 and beyond. But before I get to my forecast later in the show, I'll be talking with some of the income generation's favorite guests from 2018. These highly respected and experienced advisors have helped their clients successfully weather the storm of volatility all year long throughout 2018. And today, they'll be providing us with their market forecasts for 2019. But first, let's do a quick review of the markets this year, 2018, and let's identify some of the key issues and concerns heading into the new year. So with 1 week left to go in 2018, all the major stock market indices are down from the year. That is down from January 1st. What that means is that investors with a buy and hold strategy basically sat there all year to maybe best case, including dividends, best case, break even. The entire time enduring record level volatility for the entire 12 months. Now, of course, that volatility has been the big story for the financial markets all year long, so much so that they've devoted several recent shows to it and its many causes. Will that continue to be the big story in 2019, or will the storm subside? Will the economy continue growing at the 4% or maybe close to 4%, those rates we saw in the second and third quarter of this year? Or was that just a sugar rush from the Trump administration's tax cuts? Will the Federal Reserve approve 3 more short-term interest rate hikes in 2019 as it hopes to? Or will stagnant long-term rates, low inflation, and fears of panic on Wall Street keep the Federal Reserve completely handcuffed? These are all critical questions for everyday investors. And again, no one has a crystal ball. And as the Danish physicist Niels Bohr once quipped, prediction is very difficult, especially if it's about the future. Now that's true, but remember, predictions and forecasts are not exactly the same thing. You can make a prediction based on nothing more than a gut feeling, or even a wild guess for that matter. Generally, though, a forecast is more scientific. It's based upon your interpretation of a preponderance of evidence. It's up to the individual forecaster, though, to decide which evidence is most important and what sort of impact or influence that evidence might have going forward. With all that in mind, I'll then share my own 2019 market forecast a bit later in the show. But right now, let's get some insights from top advisors across the country. Starting with co-owner of Key Advisors Group located in the great state of Delaware, Eddie Gabor. Eddie, thanks for joining us.
Thank you for having me on your show.
You're very welcome. Now, I know you've been quite the bull for a good part of 2018. The question is, are you still that way? Let's talk about the economy first.
Okay. So in regards to the economy, for 2019, I think we're going to definitely see a slowdown in growth from what we saw in 2018, but I still see positive growth in regards to GDP of 2.5% to 3% going into 2019. So this little short-term blur happening in the market is not making me have any type of recession fears for 2019.
Now, the next question, of course, is 2.5% or 3% enough to keep the stock market happy in 2019?
Well, considering the big drop that we've just had this quarter, I now have a prediction for next year that we'll actually see a 12% increase in the equity markets due to this drop we've seen, because I don't think the Fed is going to tighten too much for 2019, which will be very bullish for equities.
Okay, so you don't think the Fed's going to tighten. So interest rates, do you think they might tighten once, twice, none? What's your best guess for Mr. Powell?
My best guess is a one and done for 2019. We still have the tariffs and lots of concerns, and a slowdown in the economy I think is going to spook them, and we're going to be looking at just one rate hike for 19, which again is bullish for equities. So,
you know, my biggest fear has always been that the Fed is going to create the next recession, but you're trying to tell me these guys are too smart, they know what you know, and they're not going to do it.
No, actually, I agree 100% with you. I just think it's going to happen in 2020, not 2019. But they will run us into the next recession.
They will, but we have enough momentum to carry us through 2019. Eddie, I always love your insight. Great job. Thank you very much for taking time today out of your busy schedule to be with us.
Thank you for having me.
Our next guest is Michael Eastham. He's the president of Fellowship Financial Group in Altamont Springs, Florida. Another repeat guest to the show. Michael, welcome back.
Thanks so much, Dave. It's always great to be here.
You always have some great insight as to what's going on. So what do you make of the economy here? The economy numbers historically throughout this year have looked reasonably strong. Now there's some talk about fourth quarter weakening. What do you think the fourth quarter is going to look like, and how's that going to affect next year in terms of the economy?
Well, I just look back at the overall, 2018 in and of itself. I mean, the Dow started off just under 25,000. It flirted with 27,000 and then back down to where it is today at just under 23,000. I mean, that's an increase of 8%, a drop of 15%, and a heck of a roller coaster ride in between. Mm-hmm. I personally think that, we're going to continue to see volatility in 2019 with the market headed south a little bit more. I mean, as much as another maybe 15 to 30% would not shock me at all, because.
Okay, so you see the market dropping, but is that because we're going to go into a recession, or is that just because the market's overinflated? What do you think about it? Do you think we're headed for a recession, or do you think we might still get some good growth, but maybe not just quite the growth that the president had promised?
I don't think it's so much not the growth. I think look, you got great economic news. You got jobs, wages, consumer spending. You'd think the market was headed north, but the fact that it isn't really tells me that there's still a substantial disconnect between the economy and the stock market. So the correction is more of a reconnecting where the market should be relative to the strength of the economy.
Okay, so you're saying you wouldn't be surprised if we're down 15 or 20% in 2019, correct?
Not at all.
Okay. Interest rates. Now, can that happen if the Fed raises rates 3 more times, or do you think maybe they're going to raise them fewer times as the final?
I think they're going to raise them fewer. I mean, interest rates continue to be a huge concern, but think about it, Dave. I mean, the Fed doesn't want to be responsible for flattening or even worse, inverting the yield curve. That could be a significant problem for the economy. But just the other day, they raised them another 1/4 of a point. So you got the Fed funds rate at 2.25 to 2.5, And what happened to the 10-year Treasury? It dropped a little bit, 2.7 to 2.8. That is not a lot of wiggle room.
You know, Michael, in spite of the fact that the Fed has created many a recession, I hope and pray that you're correct. Michael, thanks again for your ingenious words of wisdom, and it's good seeing you on the show.
My pleasure. Thanks so much.
Our next guest is Dee Carter. Dee is president of the Carter Financial Group in Midland, Texas, and also a repeat guest of the Income Generation. Dee, welcome back.
Thank you, Dave. It's good to be with you again.
So tell us, you know, the economy, second, third quarter economic numbers, the GDP looks strong so far. The jury's out for what's going to happen in the fourth quarter. What do you think is going to happen economically in the fourth quarter, and how is that going to affect us in 2019 in terms of the economy?
Yeah, I have to look at everything based on West Texas, obviously, because that's where I'm located. And right now, with the oil prices being down about 20% from what they were just a couple of weeks ago, we're looking at the economy to slow down, we think, here in this area. In fact, we're already seeing a slowdown in the economy right here in the West Texas area, which really affects all of Texas and in some small way affects the rest of the United States because of the necessity for the petroleum industry. So I think the economy is going to slow down a little bit. I don't think it's going to get much faster than it is maybe right now.
Well, I was going to ask you about oil, but now I don't have to because you led with it. How is that going to affect the stock market? Does that mean we'll have an end of 2019 with a lower stock market than we went into 2019 with, in your opinion?
Well, I think the market's jumped around so much in the last couple of weeks. In fact, the last couple of months, it's gone from 27 down to 25 to 24. It's all over the board, and that's a good indication of the way people are feeling, because the stock market goes the way people feel. They buy mostly on impulse, on greed, or trying to make a little money. And if they're not buying, then the market's going to go down. My clients here are backing off from the market big time. They're starting to look more at income situations than growth situations, just because the market is so unstable right now. So I'm expecting the market to decrease again over perhaps the next 6 months, the next year. We could see another 15 to 20% drop. It's an interesting. I just read an article where 28% of people felt it was good, 27% said it was bad, 33% no change. People just aren't really on page or on score with this thing.
You're
right
the second person who said possibly down 15 to 20. One guest said up 12. In 30 seconds or less, is the Fed going to make it worse based upon Powell's comments from last week, by hiking rates too quickly, or do you think they're going to smarten up and hike less in 2019?
I really think, based on what I'm seeing, they're going to do less. They talked about 3 times. Now they've backed off to maybe 2. They're starting to see the big picture, I believe. So if they will keep it in that area, we're already at 2.25 to 2.5. If they will keep it in that area, maybe no higher than 3, I think that's going to be okay. But it's still going to affect us, because out here, the Fed goes up, the rates go up, the price of borrowing money goes up, the drilling goes down.
Right. So they're just going to keep it from making it worse. I get that. Dee, we have to leave it there for now. Thanks so much for this. We appreciate it. Love to have you back. And stay with us. We'll be right back with more on the Income Generation. I'm David Scranton. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm David Scranton, and we're here today with a repeat guest for The Income Generation, Mr. Matthew Johnson. Matthew Johnson is the president of Johnson Wealth and Income Management in the cool little town of Humboldt, Iowa. The company's been around for 60 years. So, Matthew, we're expecting great things from you today with that 60 years of imputed experience. So let's start with the economy. What do you think's going on right now? How's the fourth quarter going to show for 2018, and what's going to happen in 19 with the economy itself? We going into recession?
Well, I definitely believe that there's a recession that is being created right now. I believe the economy is indeed cooling. If it costs more to manufacture goods, it's going to hit the bottom line and things are going to back off quite a little. I think the economy is going to really be impacted by whether or not the trade talks in March go well or not.
Okay. So you think we're headed to recession. So then how's that going to affect the stock market at this point? Do you think we're going to be able to, we've had a big enough correction, we're going to be able to stay level at this point now through a lot of 2019? Or do you think we have more blood in the streets?
No, I think that it's going to get worse. The stock market is definitely capitulating right now. Investors are really showing the fear that they have. And when investors get scared, when the normal average investor starts to become overcome with fear, he's going to capitulate. He's going to sell. He's going to try to get out. He doesn't want to have a repeat of 2008. You throw bad trade talks in there that's going to affect the corporations. It would not surprise me at all to see the Dow Jones hit 21,000. I really think it's plausible to see another 15% loss in the Dow.
15% in the Dow. Wow. Okay. 10 seconds then. Tell us, what do you think? You heard Powell's comments earlier this week. You think they're going to create this recession, make it worse by hiking too many times, or do you think they're going to smarten up and stay out of the way?
Oh, I think that they're giving themselves kind of a broad girth either way. They're going to be able to, no doubt, have the ability of adjusting. If they do, I could see them definitely doing one, maybe two. I think
two.
At this point, yeah,
okay.
I think at this point, no more than two.
All right, we need to leave it there right now. Matthew, thanks so much. We always appreciate your 60 years of imputed wisdom. Thanks for coming back. And our next guest joining us is president and founder of Stearns Retirement Group, David Stearns from Atlanta, Georgia. David, welcome back to the show.
Thank you, Dave.
All right, so, the economy, according to what everybody's saying, has been growing well throughout most of 2018. Fourth quarter is a question mark. Do you think fourth quarter is going to be a good quarter in terms of GDP growth? Is it going to be down? And how does that affect us throughout 2019 in terms of the economy?
Dave, I think that our GDP won't be too far off of the third quarter of this year, 3.5%. I think that we've got momentum right now. I think the GDP is solid. I think we're going to see the momentum carry us on into 2019 for at least the better part of the year. I think we'll probably even see some sort of an unexplainable softening with Trump and China on around first quarter of next year, which will give us a little bit more of a boost as two of the biggest economies get a jolt from that.
Okay.
And I think we're still getting some mileage
right
from the tax legislation.
So the economy is going to do fairly well through 2019. The momentum will carry. Now, how's that going to affect the stock market? Does that mean the stock market has seen its worst over the last few weeks?
Yeah, I don't know. No, I don't think it's seen its worst. I think that, Alan Greenspan just recently said, as you know, the party's over on Wall Street. He said that 2 days ago. He said he doesn't think equity prices can go much higher. He's been there. He's done that.
Okay.
I think he knows what he's talking about, but I think it will take off. The stock market will take off again for the better part of the first half of next year. I think we can continue to expect the same volatility that we've seen as the Feds unwind quantitative easing and take that caffeine away. But I think the strong economy will allow long-term rates to go back up again.
Okay, so David, 15 seconds. Do you think we'll hit a new record high in the market at some point next year? And number two, where do you think we'll end up? Higher or lower than we are today at the end of 2019?
I think that next year we'll peak out around 25,750, maybe 26,000 in the Dow.
Okay.
I think Trump will get entangled by the middle to the end of next year, and I think we'll see the market falling by the end of the year. My prediction is the market will end at about 22,000 the Dow next year.
22,000 on the Dow, and there we have it. I love your words of wisdom as usual. Thanks for being part of the show. We really appreciate it. Hope you come back.
Thank you, Dave. It's a pleasure to be with you.
Same here. And our next guest is Greg Milia, founder of Milia Advisory Group in Tulsa, Oklahoma. Also a repeat guest here on the Income Generation. Greg, welcome back to the show.
Thank you for having me, Dave.
So, the economy, is it going to stutter in the fourth quarter? Is it going to keep trudging ahead? And how is that going to affect the economy in 2019? What are your thoughts?
Well, I think the Fed raising the rates is really putting a squash on the economy. I think the economy is raising rates in a much weaker economy than they see or foresee. I kind of look back to late 20s, and you kind of see the same reaction. Started raising rates into what they thought was a strong economy, which a lot of people blame them for the ultimate correction that was very significant back then. So, I think the raising the rates is gonna shut the economy down.
Do you think we'll officially go into recession in 2019 at some point?
Entirely possible, absolutely.
So my hope is the Fed would smarten up and not continue along its path You're thinking that you're a little less hopeful that'll happen. So, okay, the recession starts. How does that affect the stock market next year? After this 15% drop, are we okay now? Is it just going to stay level, or you think it's got more downside potential in 2019?
I think we've got a lot more downside potential. I think that the stock market's at an artificial high from all the, as your previous guest mentioned, caffeine that's been injected into it. That caffeine's gone, and now they're giving it not a stimulant but a depressant, and I think it's going to have a dramatic impact.
So where do you think the stock market's going to end up at the end of 2019? If you had to give it a range, a predictive range, what would you say?
I think down at least 20 to 30% by the end of next year.
20 to 30. Well, we have a new record for bearishness so far of all the people we've interviewed. And we'll look back at this 12 months from now and we'll see. But
you'll remind me if I'm wrong, right?
And I will remind you, and I'll also tell you if you're right, because there might be one more person sitting here in front of the cameras, actually, that might be a tiny bit more bearish than you for next year. We'll have to see. Greg, thanks for being on the show.
You're welcome. Thanks for having me, Dave.
And our next guest is another friend of the income generation, Dave McAdams. He is president of McAdams Group, LLC, in Memphis, Tennessee. Dave, welcome back to the show.
Hey, thanks for having me again.
So, okay, we had a pretty good year in the economy for the second, third quarter. Fourth quarter, who knows? They're talking about maybe a lower GDP growth by a good margin. Do you think it's going to be lower, and how do you think that's going to affect the economy and GDP growth going into 2019?
Well, I do think it's going to be lower, but, it's interesting because the Fed just elected to raise interest rates, and one of the things they cited in their rationale was that the labor market continued to strengthen, economic activity is rising at a strong rate. So if you believe the Fed speak, then it sounds like we're likely to have good continued GDP growth moving forward.
Okay.
Now, GDP growth and what the stock market does are not always correlated and not always aligned.
Of
but
course.
I do think
Now talk to us about the stock market then.
Okay, so right now the Dow almost touched 27,000 in the 2018 highs. Really, right now, as of today, we're down about 15% off of that recent high, and it's not going to shock me if that sell-off continues down to maybe a Dow 21,000, which would represent about a 20% drop from the 2018 highs. Now, a little bit more, I'm not trying to be Chicken Little, but a 18,500 Dow would represent about a 30% drop. And frankly, for us to get to fair valuations in the market, you're probably going to need to see about a 20 to 30% pullback from the recent 2018 highs to find stocks in a nice happy zone where buyers would probably rush in because they're paying a fair price for the stock.
Okay.
I don't think we're going to see a 50 to 60% drop, which would obviously signal a strong entry point where price to earnings ratios would be so low that if you had a lot of money in the bank, now would be the time to load up.
Sure.
But I don't think we're facing that type of economic cycle.
So David, we unfortunately we need to leave it there for now. We're out of time. I don't understand either why the Fed's raising rates and they're talking about recession, but they're doing it. Dave, thanks for being with us. We appreciate it. And you stay with us. We'll be back with more here on The Income Generation. I'm David Scranton. Welcome back to The Income Generation. You're here with David Scranton, and I have the pleasure of being here with another friend of The Income Generation, Anthony Siccaro. Anthony is founder and president of Providence Financial and Insurance Services in the LA area in California. Anthony, welcome back to the show.
David, thank you for having me.
So, the economy. What do you see the economy doing next year? Some people think the momentum that we've seen earlier this year is going to carry them through 2019, economically speaking. Other people feel like we're facing a recession. Your thoughts?
Well, I think we're definitely more closer to the recession side of things than we are to the breaking through type of things. If you'd asked me 3 or 4 months ago, the answer might have been a little different. But the stock market has given us a very good clue. And I think the stock market is really reacting to the global slowdown of GDP. So the reality is I think we're more heading towards the recession at this point, unfortunately.
Okay. Now, do you think part of the recession is going to occur because the stock market drops and people have this reverse wealth effect that we always talk about where they feel poor, they don't spend as much, and that creates a recession? Is that a possibility?
Well, it certainly is a possibility, and I think that all interplays with each other. But the one thing that's a little bit different this time than the last few times that the market has dropped by double digits over the last 4 years is interest rates are higher. So what that does is that gives nervous people another place to go. Over the last 4 years, they haven't had another place to go. Now they do. I think that's just going to add to the slide, unfortunately.
That's going to add to the slide, and then the slide might affect the economy. Okay. Now tell us, what hand do you think the Federal Reserve is going to have in this, if any? You know, Federal Reserve has created many a recession before. You think they're going to create it now, or do you think maybe they're going to take their foot off the accelerator in terms of raising interest rates in time to maybe slow down that recession train from coming?
Well, you would have thought that maybe they take their foot off the accelerator, but Jerome Powell didn't indicate that at all. I was expecting him to be a little more dovish, yesterday when they raised rates, or last Wednesday. But the reality is that he wasn't. He was full force. They talked about raising rates again in 19. I think that's a mistake. I think that's going to be a snowball that could start the recession avalanche. And that's, and like you say, they've done it many times before.
So now, if I can pin you in a corner there, what do you think is going to happen? Where do you think the stock market's going to end up in 2019? If you want to give us a number or range, we'd love to hear it.
Well, price-to-earnings ratios are still in the 20 range. Their average is around 15, which means they got to come down 25% to break even. That puts us somewhere between 18,000 and 19,000 on the Dow. And yet, when this avalanche starts, I think it could be worse than that. But if you're going to pin me in a corner, I think we end in the mid-18,000s at the end of 2019.
Mid-18,000s, that's 30% down from where we are today. Anthony, thank you very much for being part of the show. We always appreciate it.
Thank you for having me, Dave.
And our next guest is Sam McElroy, a partner at Financial and at Financial Investments in the great city of Chicago, Illinois. Sam, welcome back to the show.
How you doing? You know, one of these days I'm going to teach you how to say that correctly.
That's how he said it in grammar school. I figure it's good enough back then in the second grade. It's good enough now, but we don't have time to talk about grammar school. We need to know, our income generation members are sitting here and they're anxious to know what you think is going to happen next year. Are we going to see a recession, or is the president going to be able to push off that recession to 2020?
You know, I think it's really likely that it actually happens next year. There was a recent survey that I was looking at where they were surveying top CFOs from U.S. corporations. And the interesting part was that 82 of the CFOs projected a recession by 2020. But some of the things that I'm seeing towards the tail end of this year makes me feel like 2019 may actually be a really good year to see that as well. Okay, so you think you might hit the recession this year. So the stock market, we're down now, let's say 15% across the broader indices. So is that enough for now? Do you think maybe the market will rebound at some point next year and then drop again with a recession? Or do you think it'll keep dropping from here? What are your thoughts? My concern is that I think it's going to keep dropping throughout the course of this year. I think a lot of things that we've seen in previous years has really had a lot to do with things that were artificially bolstering the stock market. I think for years it's been overvalued. We've been in a situation where there just hasn't really been a lot of fundamental sense from an economic standpoint. And you can only live in that realm for so long. And I think now we're seeing the other shoe fall. And my concern is that a lot of what's been priced into the market in previous years, we're now seeing start to unravel a little bit throughout the course of this year, potentially.
Even though the economy might do fine for the first part of 2019, recession hits later in the year, you're still thinking the market isn't really going to recover. We're not going to see a new high. It's going to keep sliding.
I think so. There's a couple of paths where I could see it potentially trying to jump back up, but I always ask myself based on what? What economic data could we now see that's going to make everybody all of a sudden feel that this trend is going to reverse itself and to be optimistic for the market? I think that a lot of stuff that's happening with interest rates may even further hurt it.
Yeah. Do you think the Fed's going to continue raising rates a lot next year, or do you think they're going to slow down? I mean, you heard Powell's comments last week.
I did, and it kind of shocked me. In a sense, I thought we were going to hear a lot of talk to build in a lot more wiggle room to be able to stop this kind of acceleration in terms of interest rates. But he seemed pretty determined that unless there's just a total collapse to some degree, that interest rates are going to continue to increase. And so my best guess is probably see another couple of interest rates increases next year, unless the shoes start, unless the wheels start to fall off.
So Sam, 10 seconds on a penny against the wall here. Where do you think the market's going to end up at the end of 2019?
If we're talking about the Dow, best guess, I'm going to say somewhere between 18 and 20,000. If we're looking at the S&P 500, I think maybe in the 21 to 2,200 realm.
The down 25 to 30% from where we are today. As usual, we appreciate your words of wisdom, Sam. Thanks for being on the show.
Thanks for having me.
And our final guest for today is Mr. Jeff Small. He is president of Arbor Financial Group, just up the road from me in Melbourne, Florida. Jeff, I like to say we saved the best for last. Welcome back to the show.
Well, I'm glad you're telling me that because it's true.
All right. Well, 12 months from now, our viewers can be the judge of that based upon what you say. So let's get right into it then. The economy.
Well,
will we have an official recession in 2019, or do you think the president could keep things growing and push off an official recession until 2020 or beyond? Your thoughts?
Certain parts of the economy will experience recession. We're already in recession in autos. That's just one segment, but we've been hit by about 15% as a decline in the market. And so the financial oasis that we've had is turning into a mirage as corporate earnings have peaked and everybody expects a downturn next year in corporate earnings. So we're going to see the market drop from here. It's going to be a slow and steady house of pain.
Okay, so slow and steady house of pain. The economy. Do you think we'll officially be in a recession, economically speaking, next year, correct?
The economy may not be in a recession, but the market will be in a recession because it was an overbought market. The market just got too high for its own good, and now demand is drying up as the Fed increases rates. It's causing a global contagion or an economic slowdown, not just domestically, but globally, and that's going to pull down the markets even further.
So let's talk about the Fed then. You heard Mr. Powell's comments just this past week. Do you think the Fed's going to keep trying to aggressively raise to give them, quote, more room to adjust come the next recession? Or it actually perhaps cause it? Or do you think maybe, just maybe, they'll stay out of the way of the markets and increase a lot less?
Well, I think the Fed is hyper concerned in a confidential sense of the coming debt bubble that we're getting ready to experience. And so they're ratcheting up rates to prevent the actual acceleration of debt. And we're going to see a deacceleration of debt, which is going to hurt the economy. So by the second half of next year, we will start to feel the effects of that deacceleration as we come to the peak of the debt cycle.
You think they're concerned about a debt bubble causing a recession? Is that why they're trying to do this? Is that what you're thinking?
I really do, because they've increased corporate debt in a tremendous sense, Dave, and a lot of that starts to mature in 24 months, as well as the governmental debt as well. And that's a whole nother story. But the reality is the debt service is going to double federally and also in corporate America unless they reduce rates to zero, because rates are going to zero in 24 months or less.
Yeah, and they may even go negative too for the first time ever in our history. So final thought, 30 seconds. I'm going to pin you in the corner. Where do you think the stock market's going to end up at the end of 2019? If you had to give me a number or a range, what would you say?
I think we have a 20% downward trend from here, maximum of 38%. Best case scenario, we're down 20% in 12 months, but it's going to be a trend market, and it doesn't matter what the economy does. The market's going to gradually unwind, and there's not going to be any demand for the next 12 months in the market.
Yeah, I can't argue with that. I tend to agree with you. I got to tell you, I always hate to go with the consensus, but of our 10 guests so far, you're in the consensus. One thought we'd see a bull market throughout next year, so we'll see what happens. Jeff, thank you so much for being part of the show.
Thank you, Dave.
Stay with us. We'll be right back with my prediction here for 2019. Here on The Income Generation, I'm David Scranton. So before I jump into my own 2019 market forecast, it's important that I provide you with a little bit of historical context. With the stock market poised to finish this year roughly where it started, actually below where it started, 2018 is a bit like a long-term secular bear market cycle in miniature form. Now, if you're a regular viewer, you've heard me talk about long-term secular cycles before. A long-term secular bear cycle unfolds typically over 15 to 25 years, during which time the market experiences extreme turbulence, including at least 3 major drops and recoveries, only to end up right back where it started 15 to 20 years later. That means zero growth for 15 to 20 years. Now, investors who are not aware of these cycles end up suffering through all that volatility for, zero growth. And when you factor in inflation, when you factor in lost opportunity cost, it's even worse. Now, that refers to the income that investors may have lost by not taking advantage of more stable alternative investment strategies over that time. What I'm defining is the term lost opportunity cost. As far as this secular bear cycle goes, we're now approaching 10 years since the end of the last major drop. That's nearly a record and an important piece of evidence to indicate why the next drop is not only likely, but far overdue. One of the main reasons it's overdue is that, again, we're simply not living in normal times as far as the financial markets are concerned. Historical patterns and trends that have played out in similar ways for over 200 years of market history have all been disrupted by new fiscal policies overly reliant on artificial stimulus. Now, having said that, it's also true that certain patterns and realities have started to emerge in this era of quantitative easing, and these patterns are becoming helpful to forecasters, at least those forecasters who are focusing on the right details. With that, I'd now like to share my own 2019 market forecast, focusing first on interest rates. Now, as we've discussed, the Federal Reserve's stated goal is to approve 3 additional short-term interest rate increases next year. Now, many forecasters are saying it will happen. I say that it won't happen. In fact, I believe there's probably an 80% probability that the Fed will approve only 1 rate hike in 2019. Maybe a 10% probability that it'll approve 2, and maybe a 0% chance that it'll approve 3. Why? Well, as many of you know, when the Fed first began raising short-term interest rates 3 years ago, after holding them near 0 for 7 years, I said in an interview on CNBC that the process was going to be much more difficult than others seemed to think. I knew that in order to do it, the Fed would need long-term interest rates to cooperate, that there would have to be enough economic growth, enough inflation for long-term rates to rise ahead of short-term rates. Why? To avoid that thing that we refer to as the dreaded flat yield curve. Of course, I also knew the Fed would be doing its best to manipulate long-term rates upward. How? By trying to artificially manufacture inflation. And also through this so-called reversal of quantitative easing, which involves selling the trillions of dollars in bonds that it purchased during the financial crisis back to investors in the open market. But as I pointed out that day on Closing Bell, if they couldn't manufacture inflation with rates near 0 for 7 years, it's going to be really difficult for them to manage it with higher interest rates. And sure enough, they have not been able to manufacture inflation. Although inflation did creep above the Fed's minimum goal of 2% for just a period this year, most data points to it remain stagnant in 2019 and possibly even dropping back below 2% at some time next year. Now, that's just one reason I believe long-term interest rates will continue hitting a glass ceiling, or what we analysts call a strong resistance level, at 3.25% during the entire year of 2019. And why that glass ceiling will essentially handcuff Jerome Powell and the Federal Reserve's efforts to approve additional short-term interest rate hikes. There's also other forces behind this resistance level, too. One is us, the baby boomers, the members of the income generation. We are the largest, most economically important demographic out there. But having been burnt by 2 stock market drops so far since the turn of the century, we have learned our lesson. We're no longer spending and borrowing, pumping money back into the economy that perhaps we shouldn't be. Instead, what are we doing? We're tending to pay down our debts more. We're trying to save more for retirement. Why? Because we have to. And as more and more boomers move away from risky stock market-based strategies and toward conservative options, that will also help keep bond prices up, and that'll help keep long-term interest rates down. At the same time, quantitative easing efforts across Europe and other parts of the world will also keep putting downward pressure on our own long-term interest rates. These factors are real factors that will continue to work against the Federal Reserve's attempts to artificially influence long-term interest rates. And as long as this resistance level holds on the long-term side, then the risk of a flat yield curve will increase every single time the Federal Reserve raises short-term rates, which again is why I'm forecasting no more than 1 additional rate hike in 2019 and as much as a 10% chance, maybe even more, of 0 rate hikes next year in 2019. Now, as you may know, on December 3rd, the yield curve already became partially flat when the 2-year Treasury was paying more interest than the 5-year Treasury, and it's remained that way since December 3rd. As I've mentioned before on the show, a flat yield curve has actually preceded many of the major market declines throughout history, including the 2 major market declines in this secular bear market cycle starting at the turn of the century. And the flat yield curve is recognized by economists, by and large, as an enormous red flag of a coming recession. Now, with that in mind, the second part of my forecast for 2019 is that economic growth will in fact slow and very possibly, maybe even likely, give way to a recession before the end of 2019. The evidence for this, I believe, is pretty compelling, and even some normally bullish sources are having a hard time ignoring the evidence. A recent JP Morgan survey found that 75% of ultra-high net worth investors actually believe we will have a recession by 2020. 21% of them believe it will start next year in 2019. Now, one reason is that companies, for example, have already ingested all the profits from the Trump administration's corporate tax cuts. Moreover, employment is at near capacity according to most data. Inflation, as mentioned, is expected to remain stagnant or perhaps even in decline. And the slowdown in the housing market, for example, that began mid-year is expected to continue. As you heard Jeff Small mention, we already have a recession starting in the auto industry. Those are just a few of the signs pointing towards stalling growth and a possible recession. Now, there are others, along with a host of unknown factors that can make the economic outlook for 2019 perhaps even a little bit bleaker than I'm portraying here. We'll talk about that more in just a bit, and I will share with you the final piece of my 2019 market forecast that is about the stock market in just a moment. Stay with us. We'll be right back with more here on The Income Generation. As noted, in addition to all the factors that we've discussed, there are a number of geopolitical issues and situations that can make the economic outlook for 2019 perhaps a bit darker than discussed. Those include some of the issues we talked about all year on the show: the trade war, economic instability in Europe, Asia, and elsewhere, the mounting federal deficit, the political turmoil in Washington, which is only likely to increase in 2019 now that the Democrats have the House of the Representatives. Even if none of those situations escalate and lead to a tipping point for the stock market, remember that emotion is the market's main driver, and that fear alone can have real consequences. For example, it could trigger the so-called wealth effect, but in reverse. Even if the stock market only goes down a little, people may start to feel just a little bit less wealthy and therefore perhaps a bit less confident about spending. That helps fuel a recession. And if a little market dip causes people to spend a little less, a major dip could cause them to spend a lot less. Suddenly the recession is huge, prolonged, and it drags the markets down even further. It's basically a matter of the tail wagging the dog until the dog starts wagging the tail again. So, with that in mind, the final piece of my forecast for 2019 is indeed a stock market drop. Possibly the third major stock market drop of this bear market cycle. And if you remember, every single one has had 3 major drops before. Ultimately, this market has to have a 40% drop from where it is today to get below some of the resistance levels on the market, right around 1,500 on the S&P 500. Whether that happens in 2019 or extends in 2020, we'll have to see. But either way, I do believe the stock market overall will end 2019 lower than it goes into 2019 for all the reasons we just discussed, as well as because the market has been overvalued relative to economic growth for years now, thanks largely to artificial influences such as quantitative easing. It really needs to start making fundamental sense again, and I agree with a lot of our guests that the volatility we've seen this year is a sure sign that the process may finally be starting. I also believe you can count on it continuing through 2019. Now, could there be some big spikes in gains over the course of 2019? Of course there can. If the trade war gets settled, if oil prices stabilize, or the Federal Reserve totally takes its foot off the gas on raising interest rates, as I believe it will, then yes, some periods of gains are possible, which day traders can take advantage of. In fact, it's a safe bet there's always going to be some occasional good news throughout the year that gets Wall Street briefly excited and possibly even triggers a new record high or two. It's probably also a safe bet that analysts who are stock market cheerleaders will focus on those factors and on the occasional spikes to support their own forecasts of a booming market for the entire year. But I do believe those spikes will prove to be just more of the extreme volatility we've experienced so far this year in 2018, a continuation of the storm, in other words, and that ultimately the market will finish 2019 with a loss. So what does all that mean for investors over the age of 50, members of the income generation like us? We'll talk more about that in my summary coming right up. Stay with us. We'll be right back here on the Income Generation. I'd like to thank all 10 of our guests for joining us for another episode of the Income Generation. Of course, I'd like to thank you, our new and returning viewers. So let's recap. Of our 10 guests, the consensus seems to be half of them believe a recession in 2019, but all but one believes that we'll end the year lower in 2019 in the stock market, with a majority being in that 15 to 20% range and another group being 25 to 30%. And one bull saying, Eddie Gabor from Delaware, saying we're going to end up by 12%. To summarize my forecast, I anticipate the Fed will be able to approve no more than one short-term interest rate hike, possibly none next year. Why? Because long-term interest rates are going to continue to hit a strong resistance level at 3.25%, threatening a fully flat or inverted yield curve. Next, economic recession, yes, is likely in 2019, or at least a significant slowdown in the growth we've seen this year. Third, I believe the stock market loss is likely from the start of 2019 to the end. Yes, there could be some spikes in between that day traders could take advantage of, maybe even getting near the previous peak of 27,000 on the Dow. But in the end, it'll prove just to be one more set of extreme volatility points that we've experienced all year. A continuation of the storm, in other words. With all this in mind, it's up to you to decide whether you want to continue riding the storm out for another year or whether it's time to take shelter. While no investment strategy is 100% safe, if you're a regular viewer, you know I believe the safest, smartest option for many investors today from the income generation is investing for income. Those income-based strategies are designed to protect your investment principal and generate reliable income to meet your retirement goals regardless of stock market conditions. And that includes the kind of extreme market volatility we've experienced through 2018 and are likely to experience again next year. Keep in mind, those who successfully rode the Wall Street storm out this year are likely to end up just breaking even if they're lucky. And if the stock market does indeed finish at a loss next year, as I'm forecasting, they won't ever be that lucky. Keep in mind that in this unprecedented age of economic uncertainty, the reality for 2019 could be much worse than I or anyone else are forecasting. And most importantly, keep in mind that continuing to ride the storm out isn't necessary. There is an alternative, a way to protect your money, to grow your portfolio strategically, and create a reliable income stream to achieve your retirement goals without having to worry about market turbulence. Make it a resolution to learn more about it in 2019. Happy New Year! And thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's essential you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton. Thanks again. We'll see you next week.